The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, ladies and gentlemen. Welcome to a Standard Bank webinar hosted by SBFC, which is Standard Bank Financial Consultancy. My name is Ketiwa. I'm going to be the coordinator today. We've got two presenters today addressing our topic, which is diversifying your risk, bearing in mind your goal and tenure to invest. Thank you very much for taking the time to sit with us today for the next 40 minutes for this interesting webinar. Our two presenters today is the famous Errol Mayer that we love so much, as well as Winfred. Now, Winfred, you don't know, it's Winfred Haynes. Winfred is the head of our retail investment funds at Standard Bank Wealth. So he's going to be joining Errol Mayer. The reason we chose Winfred is because he's got 21 years of industry experience. Winfred joined Standard Bank in 2015 to head up the bank's retail investment funds initiative. Prior to joining the bank, Winfred spent more than 17 years in the investment management industry, of which about 9 years was with multi-managers such as Investment Solutions, Momentum, Outcome-Based Solutions, and most recently a short stint at Signia Asset Management. So that's the reason why he is the co-pilot today for Errol Mayer. A lot of you already know Errol Mayer, but just to give you a reminder of why we love him so much, Errol Mayer is not just talk. He is a certified financial planner and an admitted advocate of the High Court SA, has written many tax and financial planning articles, authored a book, very interesting, Notes on Estate and Financial Plans, also has worked as a tax advocate for SARS, and currently Errol is the head of advisory propositions at Standard Bank. Like I always say, we only choose the best for you. Just to remind you, the topic is diversifying your risk, bearing in mind your goal and tenure to invest. But before I hand over to the two gentlemen, some housekeeping, 2 points. First one, guys, if you have any questions during the presentation, on your right-hand side, there's a panel that you'll see that has a heading called Questions. If you have the question ready, you type up the question. At the end of the presentation, we'll then address the question to Winfred, and then he will give you the answer. During the presentation, we will not disturb the two gentlemen as they speak, so that we can have a fluent presentation. And then second thing, I just want to make sure everybody can hear me clearly and that you have no problems with seeing the screen currently and hearing my voice. There's a small high five on the panel on your right-hand side. If you don't mind, just click that small hand to show me that you can hear me and that you are with us. I'll be very happy to see that. Okay, I can see some hands. Thank you, Yolandi. Thank you, Vanessa. Thank you, Robin. Thank you, Richard. Okay, majority of hands are going up, so I assume sound is happening and it's working well. If I sound soft, guys, on your taskbar at the bottom of your screen, you can just increase your volume as well. That also helps during the presentation so that you can hear everything clearly. Okay, I'm going to hand over to the gentlemen now who are going to start our presentation. Good afternoon, Errol. Good afternoon, Winfred. Thank you so much for taking the time to do this for us today. I'm handing over to you. Good luck.
Thank you, Ketiwe, and good day, everyone. Well, let's kick off. And on the first slide, there you can see it is the delay. On the first slide, let's have a look at the content. So firstly, we will briefly position goal-based financial planning so that we have a clear understanding why it is necessary to understand goals-based investing. And thereafter, Winfred will take us through some investment fundamentals and then how to build a portfolio. So let us then, first of all, look at a picture that should be familiar. Let us refresh our memories. Have a look at the slide and see the different role players. There you'll see the financial planner, you'll see the investment team, as well as the client. And those three together are the role players in the story. Goals-based financial planning is a financial planning philosophy that puts the client's needs first. The financial planning process is kicked off with the guidance of a financial planner who is responsible for determining the client's unique lifestyle choices and defining them as goals. Hence the phrase goals-based financial planning. Typical goals will be some or all of the following: to be financially independent, the date when I can start with a small business as a second career, the date of retirement, to save for my children's education, to save for a child's wedding, a deep-sea fishing vessel, or to go on an overseas holiday. And so every client is unique, and some goals will receive a greater priority than others. Now, stated differently, it is about each client's unique set of lifestyle goals while balancing creating value and giving purpose to the client's wealth. In order to give purpose to these goals, we have to calculate the amount needed, taking inflation into consideration, and then build an investment strategy for each goal, simply because one may have limited resources to create value. Resources to create value include by income earning structure and passive investments. Also, each goal has a different time frame, and some are just not as important than others. To give effect to these lifestyle goals, an investment strategy must be put together to ensure that these goals can realize in future. It is simply not good enough to aim for the highest return of an investment asset class without having regard to the term that is needed and how important it is not to miss a goal. This is where investment planning and financial planning come together. For that reason, we have to devise a tailor-made investment strategy for each goal. This is what we will be discussing in this webinar. Investment portfolios are tailored by a dedicated investment team, referred to the slide, working very closely with the financial planner to deliver on the long-term financial goals of the client. It is therefore important to understand some of the basic and core investment principles that underpin such an approach. And now I'm going to hand over to Winfred that's going to take you through the investment fundamentals.
Thank you, Errol. Good day, everyone. So I think one of the core investment principles to start off with is that of compounding. Now, compounding is the ability of an asset to generate earnings, which are then reinvested in order to generate its own earnings. In other words, compounding refers to generating earnings from previous earnings. This is, of course, what allows a very average saver to become a wealthy individual. The secret to compounding is not how much you can afford to save, but when you start saving. So the first graph on the left-hand side shows how important it is to start saving early. Sipho invests 10,000 Rand at age 25. He has reached over 100,000 Rand by the age of 65. Shelley, on the other hand, starts saving at age 35, that is 10 years later, when she invests 10,000 Rand. And in her case, she is only able to reach 57,000 Rand at age 65. The second graph on the right-hand side shows how much you need to save per month in order to reach 10 million Rand by age 65. On the left-hand side, you can see that when you start at age 20, you've got to put aside 3,628 Rand per month. But as you delay, so the amount of money that you've got to put aside increases. And on the right-hand side of that graph, if you only choose to start saving at age 50, the amount that you've got to put aside on a monthly basis increases to 34,386 Rand. So looking at these two graphs on your screens, it is clear to see why Albert Einstein referred to compound interest as the eighth wonder of the world. But what about the effects of inflation, you could ask? Surely the interest you earn must be more than inflation, otherwise it will eat into your savings. Let's take a look at inflation and what it is. So inflation is a sustained increase in the general level of prices for goods and services. What we do sometimes fail to realize is how inflation affects us. Research has shown that inflation is South African enemy number one. Why is this the case? Well, let's look back at how inflation has affected us historically. In 1984, the old faithful 1.3 litre City Golf was launched in South Africa at the princely sum of 7,635 Rand. The last City Golf rolled off the production line on the 21st of August 2009 at a retail price of 113,400 Rand. We selected the City Golf because it is one of the few cars that did not experience much technology upgrades over the years of production. So what you got in 1984 is pretty much what you got in 2009. However, it cost you 11% per annum more over that time period. And I think similarly, the price of petrol has increased so dramatically that with the money you used to fill your City Golf's petrol tank in 1984, you would only today be able to fill that tank up to 5%. And I think that really brings the message forward. Having looked back, let's also perhaps take a look forward. And by way of example, for parents willing to pay 200,000 Rand, let's say, for 1 year's tuition and board at a top Cape Town private school in 2016, due to the average private school inflation rate, roughly of 9.2% per annum, those same parents can expect to fork out at least 482,000 Rand for the same tuition and board in 2026, only 10 years later on, or 25 years later on in 2041, a staggering amount of 1.81 million Rand per year. Therefore, if your retirement income does not at least grow in line with inflation, you will either experience a decline in your standard of living, or you will simply run out of money. Given the effects of inflation, the next logical question is, what should I invest in my savings in so that I can experience the full benefits of compound interest and earn returns in excess of inflation so that I can achieve my goals? To answer that question, it is important to gain a broad understanding of different types of investments you can make and how they relate to each other. Here we detail the main types of investments known as asset classes, which are accessible to the investing public. Cash refers to physical holdings of cash and short-term assets that can easily be converted into cash, that is liquid assets, such as deposits, money market funds, and other interest-bearing investments. Cash, therefore, is not only just money in the bank. Bonds or fixed interest is when an entity like a company or a government needs to raise money. It may issue bonds to investors. A bond is a debt instrument whereby an investor loans money to the entity at a certain interest rate and for a fixed period of time. The price of bonds, of course, fluctuates throughout its life, and it's influenced by factors such as changes in market interest rates, by the credit quality of the borrowing entity. We all know about our rating agencies, AAA, BB-, you name it, or the period of the loan, that is the maturity term of the bond. Property as an asset class refers to land and anything fixed to it, like a building or a structure. It can be residential or commercial in nature. Investors can invest in property by buying property or renting it out, purchasing shares of real estate companies, or investing in property funds. And finally, there's equity. Equities, or stocks or shares as we refer to them quite often, represent ownership of a company and a claim on the company's earnings and assets in the event of liquidation. The return on a share comes from two sources, very importantly: capital appreciation, which is an increase in the market value of the share, and secondly, dividends, which is what they will declare from time to time rather than retaining earnings within the business. Now that we know what assets are available for us to invest in, let's look at the attributes of these asset classes and how to evaluate them in terms of risk and return, as well as something called correlation. Modern portfolio theory tells us that investors are able to find the best mix of assets to invest in by evaluating the asset classes, the cash, the bonds, the property, and the equity that we've referred to. On the basis of let's go through these, let's talk about risk. So that is how these assets returns differ from the average return over a period of time. The more volatile an asset, the more difficult it is to predict where the price of an asset might be at a future date, hence the risk associated with the asset. If we look at returns, how the asset is projected to perform over a period of time under normal economic conditions. So generally, what we'll find is the higher the expected return of investment, the higher the risk, and vice versa. And finally, correlation, which is the relationship between asset classes. It is the measure of the tendency of the returns of one asset to move in tandem with those of another. If we evaluate the risk, return, and correlation of the asset classes, we would see the following. When it comes to cash, because of its low volatility, cash is considered a safe method of investing in times of market uncertainty. This is reflected in relatively low returns. Cash tends to have a low correlation with all other asset classes. If we use the analogy of asset classes as soccer players, I think we can all identify with that, whose purpose it is to win a match by scoring goals against the opposition, and let's call the opposition inflation, we can think of cash as our goalkeeper. A goalkeeper prevents losses, but doesn't necessarily score goals, or that is, earn high returns. If we move on to bonds or fixed interest, as a result of changing bond prices, the bond market is volatile, but over the longer term, it enjoys superior returns to cash. In our analogy, we can think of bonds as a defender or a midfielder. Property is an investment that can increase significantly in value, and we all know also provides certain tax advantages. However, changes in the economy can make it difficult to predict property's value over time. And finally, equity. We know stock markets are volatile with significant variation being experienced on a day-to-day basis. To compensate investors for taking on the relatively high risk of equity investing, equity delivers higher long-term returns. Equity would represent our attackers, our forwards in the soccer game. They don't stop the other team from scoring, that is, they don't prevent losses per se, but they score our goals. They definitely earn the higher returns. If we look at risk and return of asset classes perhaps in another way, the table in front of you shows how the asset classes, and here we've included global asset classes, performed relative to each other over the past 12 years. Those are calendar years. First denotes the best performing asset class, and seventh position the worst. By focusing on the asset classes in this table individually, we can see the return by looking at the rating of the performance of these asset classes. We can also see the risk by noting how this rating has changed, that is the volatility over the 12-year period. Let's actually illustrate this and look at an example on South African bonds. You can very clearly see how the performance of South African bonds has changed from one year to the next. And if you look very closely, hopefully you'll be able to see a W pattern emerging. If we had to look, for example, on South African equities, again very clearly how in isolation this asset class's performance changes from one year to the next. It is therefore clear to see that performance of asset classes in isolation remains unpredictable. So your natural question would be, so what is the solution? How do I resolve this dilemma? And the answer lies in diversification. Diversification enables you to reduce the risk of your portfolio without sacrificing potential returns. So how does this work, you could ask? If one had invested, say, 100 Rand in each of the various asset classes, let's go back to 1995, let's see how your money would have performed over this 21-year period. 100 Rand in cash would be represented by the green line, 100 Rand in bonds, and 100 Rand in equity. The dip in the equities graph is the financial crisis in 2008. If you were invested in equities, you would have lost money over this short period. Only a diversified portfolio would have been able to weather such a crisis. So let's look at how a diversified portfolio solution would have helped you over this period. Such a portfolio would allow you to achieve your investment goals, giving you a much smoother ride with less shocks along the way. When building a portfolio, research has shown that the largest contributor to achieving a desired goal is the strategic asset allocation. That is the mix of assets within the portfolio. From the pie chart, you will see that it explains 91% of a portfolio's performance, whereas only 5% can be explained by picking certain shares, that is securities selection. But how do we know what assets to include in our portfolio, and how much of each asset to include? And how does this mix of assets change if my goal is to target, say, inflation plus 2%? Or what about inflation plus 6% on the other extreme? Remember, we always want to look at achieving our goals taking into account the effects of inflation so that we do not fall short. In our world, we rely on industry professionals to build our portfolios to ensure we are able to meet our goals. The first step is for the expert to determine the long-term, annual, real expected return of each asset class. That is the return that this asset class would achieve after taking the effects of inflation into account. And that is what we've shown on the screen. This is calculated based not only on historical returns, that is how this asset class may have performed in the past, but most certainly on future expected returns, that is how we expect this asset class to perform going forward. If we, for example, had to single out South African bonds and, for example, South African equities, you will see that for South African bonds, we expect to deliver a real return of 2.6% per year. So if inflation averages 6% per year, we expect to achieve a nominal return of 8.6% per year. Similarly, if we had to focus on South African equities, we expect them to deliver a real return of 7.4% per year or 13.6% per year in nominal terms based on the same average inflation expectations. And very importantly, these are long-term expected outcomes. So now going back to what we've previously stated, the experts take these real returns. They take into account the volatility of these asset classes, the correlation of these asset classes, and they input these results into an optimizer of some sorts. The asset allocation optimizer provides an indication to us of what the best mix of assets would be to achieve our particular goals. Returning to our soccer field analogy, if we, for example, look at the portfolio as a soccer team with a goal to beat inflation by 2%, that is our opposition. Remember, our goalkeeper is cash, our defense or midfield is bonds or fixed interest, and our attackers would in this case be equity. The mix of players that we've shown by illustration on this picture allows us to achieve our goal of CPI plus 2%. Or if we wanted to increase that goal, and we've got a more difficult opponent to beat, being inflation plus 6%, by changing the mix of our players, that is by adding more attackers, equity, and taking away some of our defensive midfield players, bonds, you will have a more volatile portfolio, but you will in return be able to score more goals. This mix of players will allow us to achieve our goal of CPI plus 6. What we've been talking about using our soccer field as an example is the strategic asset allocation of a portfolio. That is, how much of a portfolio is made up of each asset class. If we look at a real-life example of strategic asset allocation, we can refer to two already existing portfolios in our gold standard range of funds. Firstly, a conservative portfolio, Gold Defender, which targets returns of CPI plus 2%. That's shown on the left. And on the right, an aggressive portfolio, Gold Accelerator, which targets returns of CPI plus 6% per annum. At the extremes, you will see that Gold Defender on the left-hand side has a strategic asset allocation of 45% to South African cash and only 5% to South African equity, while Gold Accelerator on the right-hand side has a strategic asset allocation of only 2% to South African cash and a much higher 65% to South African equity. Fund managers also use cash flows that they receive from clients and their discretion to vary these percentages over time. This is called tactical asset allocation. If we, for example, now had to look at a practical example of how one could implement a Gold Defender solution and reinforcing what we've spoken about so far, let's understand how we expect a portfolio like Gold Defender to behave. Mr. Peterson, let's say, receives a bonus of 50,000 Rand. And he wants to invest this money to be able to afford a holiday for him and his wife in 10 years' time with a current cost of 90,000 Rand. If Mr. Peterson invested in a conservative portfolio, let's say Gold Defender, he would be able to achieve his targeted return of about 161,176 Rand, which is what 90,000 Rand would cost in 10 years' time, as follows. There's a 50% chance or probability that he will receive more than 161,000 Rand, 176, and a 50% probability that he will receive less than 161,176 Rand. The funnel of returns shaded in the graph allows us to focus on upside and downside risk, and what we have shaded for you there is where we expect 90% of the future returns or outcomes to lie. There is also, importantly, a 5% probability that Mr. Peterson will receive less than 134,761 Rand at the end of the 10-year period, and a 5% probability that he will receive more than 192,118 Rand at the end of the 10-year period. So very importantly, let's understand what those likely outcomes are when invested in a portfolio such as Gold Defender. If we were to now extend the example and Mr. Peterson chose to invest in a more aggressive portfolio such as Gold Accelerator, you can see from this picture that the funnel of returns is now a lot wider than the conservative portfolio. This is largely as a result of the aggressive portfolio holding a much higher percentage of the more volatile asset class, namely equities. In this instance, there is a 5% probability that Mr. Peterson will receive less than 89,879 Rand at the end of the 10-year term, but there is also a 5% probability that he will receive more than 287,180 Rand at the end of the 10-year term. So importantly, there are two things that we can take away from this analysis. With an aggressive portfolio, with a much higher allocation to equities, one can achieve higher returns than a conservative portfolio. But secondly, let's understand the increased volatility that goes along with this. And this equally therefore also means that you can achieve lower returns in the process. To end off, let's look at the different portfolio options and understand that it is clear that the uncertainty of achieving returns using a more aggressive solution, such as the Gold Accelerator option that we've demonstrated, might dissuade investors from selecting aggressive portfolios. However, we have yet to look at the effects of time or the holding period of an investment. The longer the holding period, the lower the risk of an asset class such as equity, and hence aggressive portfolios. This is because sporadic bouts of losses in the stock market are averaged away over longer periods of time. So in the graph in front of you, you can see that over any 1 year period, and we've tested this back, going back 20 years at least, equities have been very volatile, with rolling 1 year returns ranging from minus 38% to as high as positive 72%. However, you can also see that equities are far less volatile the longer the holding period. And after holding equities for more than 5 years, one generally only experiences positive returns. Ladies and gentlemen, thank you for your time participating in the webinar. I'm more than happy to take any questions.
Thank you so much, Winfred. Very insightful. So took away compound interest is magic, and time is very important. It's key, as well as I like that soccer analogy that you use in the field. Maybe Bafana can take a page out of that book, look at strategy and see, yeah, how we can win one game maybe. In the beginning, Q was having problems with sound. I hope that came back. We lost sound for 2 minutes. It's back now. Wonderful. I think because we are so clear, guys, the questions are not that many because people got it. You spoke in a language we all understood. You don't have to be a financial planning buff to understand. It was very insightful. Ladies and gentlemen, if you have any other questions or you'd like a financial planner to be in touch with you, or you'd like to sit down with a financial planner and you're a customer of ours, please walk into any Standard Bank branch in your nearest area and ask for a financial planner in the area. If not, tomorrow you'll be getting a thank you note from us just to thank you for your time, for participating. On that thank you note, you'll get some contact details, an SMS line and a phone number that you can call, and someone will be in touch with you to set up an appointment. So hopefully that is easy enough to understand. Errol Mayer, thank you very much. You were great. Winfred, thank you very much. You were awesome. Lovely presentation. Thank you to Aaron, who's sitting in the room with us. We'll see you for our next webinar. You will get an email, an invite for that. And if you have the time, please sit down and attend. Thank you very much, guys. Have a good day. Have a productive day, and we'll see you next time. Oh, before I go, I see someone asking if we could get a copy of the webinar. Yes, on the thank you note, you'll get a YouTube address that you can go and see the recorded version of this. If you're a planner, it will be on the SBFC portal as usual. Okay, goodbye.